We have Sunil Subramaniam, market expert, joining us. Sunil sir, good morning. We've seen 8 days of correction followed by some reversal. How do you see the market construct looking like for the next few months then?
I see that the market will be still in a consolidating move, but with a slight upward bias. The reason is that FIIs, despite all the good news and the good RBI policy, continue to be net sellers. There's some moderation. I think against 35,000 crores in August, they sold only 23,000 crores in September, but it's still a net sell for the FIIs. Hence, the market, for it to really strongly go up, we need a change in their attitude and outlook towards India. But domestic liquidity is strong. I think RBI governor's steps have further strengthened it with lending against shares limit going up to 1 crore. So you can see that HNIs will probably tap into that lending for various purposes, including the stock market influence. The second aspect here, which is likely to keep the market range bound, is the heavy dose of IPOs that are likely. I think it's about 75,000 crores are just coming in this month, and even for the rest of the year, the pipeline looks very strong. So both FIs and DIs are likely to allocate some money out into these for the anchor books. So I think to that extent, some liquidity will be deprived from the secondary market. The third aspect, of course, is that why I don't expect too much of a correction at this now and an upward bias is because I think that the markets are going to, by and large, ignore the actual earning results of this quarter. The reason is there are a lot of headwinds there. The tariff headwinds for the export-oriented sectors are there, but then you also have the announcement on the GST, and the date was fixed at 22nd. So you had only 8 or 9 days in this quarter. So I think if you look at it, I don't think the market is expecting much greater than in the large cap space, probably a mid to high single digit 7 to 8% single digit growth in the EPS, and maybe slightly better for the mid and small cap. So the earnings season expectations are not very great, and hence I think even if there are any disappointments that come through, it will be absorbed by the market because the focus will be with the festival season ongoing. Daily you have reports of the Navratri sales coming through. October 10th onwards, the results starts this week, but by 20th, you have Diwali sales also coming in through. So you will have a very good positive momentum in the market from the fact that the top line sales numbers are probably going to be record breaking. Right. So I think to that extent, the market will get comfort from the fact that overall outlook for the economy is looking good, though this earnings season is not great. The second aspect on the earnings season, which I'd like to highlight, is that the commentary plus the guidance are probably much more important this quarter than in earlier quarters. Why do I say that? Because the sales which have happened since Navratri, right? What margins impact are they going to have? Now, top line numbers are going to be good. But if there's any clue in terms of the margin impact, that's something they would look for, analysts. The second aspect is, of course, this is the crossover quarter when a significant section of the analysts will shift their focus onto FY27, right? So to that extent, a discounting of one more year of EPS growth would make those valuations look a little more reasonable. And so specific sectors and stocks, they would look to see what is their outlook for the future in terms of the overall scenario. And the final point here is that I think also they would look for clues from the private sector capex perspective. It'll still be only clues. We don't expect very strong action, but given the sales at the top line, they're probably going to listen to these consumer-oriented companies and see are they going to be running short on capacity, and so do they start talking about their capex plans for the next year. So a whole lot of talk is key at this earnings season, and hence I think that by and large there will be a positive momentum, but like I said, for the market to touch new highs, you have to wait for a reversal in the FII outlook to India, and for that the big elephant in the room is, of course, the tariff scenario. And until there's some resolution around that front, we have had bipartite trade talks both ways post the 50% tariffs come through and go, but nothing significant has yet come out. We're still talking about red lines on both sides. But if we are to go by the CEA's statement that by end November, he expects a resolution of some sort on the tariff front, that's the reason to hang on to. If really something comes in, even an interim trade deal comes in, then I do see that that's likely to make FIIs shift their allocations towards India, in which case market could easily touch new highs. So a whole lot of information, and so it's a month that you eagerly look forward to in terms of analyzing the overall scenario.
Okay. Sunil sir, you mentioned that, this quarter, from next quarter is where the street is anticipating some good results to flow out. This quarter, we are expecting some underperformance as well. What would you suggest investors to do? For a quick buck money, is IPOs the current savior for investors at this point of time then?
See, what's happened is RBI has helped them by increasing the lending limits against IPO from 10 lakhs to 25 lakhs. So clearly, retail investors will be tempted to put in much larger amounts. Now, those IPOs which are going to be very successful, right? I don't think this is really going to make a difference because the proportionate ratios will kick in. But IPOs which are not really in favor, their subscription levels will shoot up because average retail ticket size of subscription is going to go up, right? So from that point of view, I do sense that retail investors would tend to subscribe to more IPOs. Now, whether it's going to pay off or not is a function of the overall market. But one good healthy sign that we are seeing, and reports are there that from a grey market pricing to the actual IPO pricing, there's a significant correction, which means that it gives the optimism that they are more reasonably priced now when they are coming to the market, and to some extent, so some amount of upside can be probably expected because companies are now placing those price bands at a much more reasonable level and not at a boom down time when they really tend to overprice this stuff. So I think it's a reasonable set of scenarios, greater liquidity in the hands of investors combined with more reasonable pricing. I do expect that retail investors would pay greater attention to IPOs. What the result of that, time will only tell.
Okay. Some big IPOs opening this week as well. Tata Capital and you have LG Electronics. How is your perspective? Are you subscribing to any of those two?
Oh. I don't really like to talk specific.
All right. Yeah, of course. All right, let's also talk about banks because they have steel in the streets action right now after the RBI's policy action. What would you expect? Because given the private banks, they've underperformed PSU banks in the last couple of months. Do you expect the upcoming business updates that have come in from HDFC Bank, Kotak Bank, do you find them as an encouraging sign for the reversal in the underperformance?
Not yet, because see, this season is going to be a season to boost top line for everybody. So even banks, I would say, would sacrifice their net interest margins to try and achieve loan growth, because see, loan growth has not been great, and consumer sales also prior to the GST announcements have not been great. So I think it's a combined effort. Of course, the government and the RBI have done their bit in terms of rate cuts and tax cuts, but I think the corporate sector and the banking sector are probably going to throw all their guns at this festival season to make sure that the customer goes and spends. So I think that banks would sacrifice their margins in the near term in the interest of the loan growth book. So to that extent, right, I would say near term, the margin numbers, especially this quarter's numbers when they come, margin numbers, there will be a little bit of shrinkage in the NIMs. And even for the next quarter, I think because the loan growth would pick up, but the margins would probably be still under. So there's an extent that private sector banks, as you mentioned, they are going to be the leaders, those and the NBFCs in this festival season retail play. The PSU banks, are not so competitive in terms of this because of the turnaround time and the processes they follow. So to that extent, not lending and this highly competitive time might work in their favor. And from a medium term outlook too, as a private cycle, capex cycle picks up, I would expect PSU banks then to perform better, and I think that's what the market is also discounting. Plus, I think the RBI's efforts at relaxing a lot of norms, I think will help a lot of the good quality public sector banks too. So I expect this momentum in favor of public sector banks to continue for some more time. I think private sector banks, you will wait for the company specific, loan growth plus NIM plus NPA coverage to really take a call. I think it's early days to do that before the earnings season happens. So there will be still a bit of caution, though overall the RBI governor's policy had a fabulous impact on the banking and NBFC sector, with number probably 22 was the number of reforms or rationalizations they brought in. So private sector, public sector, NBFCs all are going to benefit. But I think relatively, because of the relative undervaluation of PSBs versus private sector also, there's a lot more catch up that the public sector banks can grow. So to that extent, I would expect that for private sector banks to outperform public sector banks, it would take a little more doing.
Okay. So, sir, would this mean that we've seen some good collection trends coming in from the MFI pockets also? We've seen in the past few months how they have already been under strain of correction itself. Would you say that you can relook at it, given the asset quality trends have been started to improve?
Definitely post the earnings season. I would still wait to understand from the companies. But I'll tell you why I'm also positive there is because I think if you look at the GST cuts on the FMCG, right? I think that's one cut which will go straight as savings into the lower middle classes pockets. Because you take an example like a soap, right? If a 50-gram soap is being sold at whatever 20 rupees, let's say, now the savings in GST, the point is that they're not going to reduce the price by that. They would rather increase the size of the soap. You get my point? So this can go through a number of these small ticket packaging. So customers to feel the impact, right? So the savings is better than the fact that the FMCG sales will go up. Why I'm saying when this is savings in the lower middle class, they are the key segment for the MFIs, right? So when they have a little more savings, then they're more likely to pay back those loans than to delay or to default, right? So I see that as a positive silver thread here. But like I said, it's better to wait for the earnings season discussions to happen and understand this space better. But I'm unbiased towards I expect an improvement to continue.
Okay. Let's also talk about IT stocks. We have TCS, which will be reporting its results, from Thursday itself. It'll kickstart India Inc.'s Q2 results. Sunil sir, what are you watching out for? Because we are expecting that the Accenture also has, highlighted that the demand trends are going to be weak. The guidance has been quite soft. But from a management commentary perspective, what are the factors that you are watching out for?
So I will watch for 3-4 things. So first is that I think the deal wins, right? So there are big deal wins those are important because that will indicate that the buying atmosphere in the US and Europe is changing. So look out for any big ticket deal wins. Second is I do expect that their rupee based earnings will grow because rupee has depreciated. But on a dollar basis, right? On a constant currency basis, I want to see how the earnings outlook is, right? To what level that is. That's the second part. Third part is that some commentary from them on the H1B visa impact. My understanding that it's not a big impact because most Indian IT companies have shifted a lot of their H1B related workforce to nearshoring, onshoring and stuff like that over a period of time. If I saw the data last time when the H1B thing came out, was that top 5 IT companies had only about 13,000 H1B applications got approved. It was more the India employees by the American MNCs like Google and Meta, which was dominating the H1B pool. So, but still, market had taken this news negatively. So, the commentary from TCS to say that what is the impact of the H1B definitely will be a part. Even if they don't talk about it, the analysts will question them. So, it'll be interesting to hear their answers and reinforce what I feel that really H1B is not a very big impact. And finally, what I expect also is again a little bit of a contrarian thought that I am expecting a rationalization in the workforces. Yes, partly due to AI stuff, partly due to this. But to me, while that's not great from a hiring perspective for the IT sector, I think it shows smart thinking by the companies that in a time where there's demand slowdown, if they are focusing on rationalizing the workforce, that means their margins are likely to be protected. So while it's generally a negative thing, hiring is viewed negatively. When they said about those 12,000 workers they're laying off, market took it negatively. But actually it's a positive because the company is managing its overall staff adequate to the demand. So I would also look at how they are going to talk about the attrition and voluntary attrition versus forced attrition and what is their outlook on hiring fresh AI related workforce. So a whole bunch of things to look forward to.
Okay. So, sir, also you talked about the consumption theme as well. Let me touch upon that as well, because we've seen a good run up in the auto space as well. How would you expect the other, consumption theme to pan out for, be it your durables or your staples for that matter?
So, first of all, as I just explained to you in the FMCG staples pack, I don't think the GST is really going to lead to a lot of sales improvement. People don't buy more soaps and more hack creams and more things just because their prices become 5, 10, 15% cheaper, right? So there will be savings in their pocket. So it's not necessarily a very big positive from a growth perspective, unless the FMCG companies keep some of the savings in GST to themselves, in which case it's positive from their EPS perspective. So we'll wait for the earnings season to see whether their margins get, but top line, I don't expect the staples to really show any great growth in this particular period. On the auto pack, yes, the numbers are already coming through to show very good growth in demand across the auto pack, and so that's reflected in the prices. But a lot of the price now, this price is in the good outlook is in the price already. I think auto has run up fairly recently, like you mentioned. On consumer durables, I think you have to clearly separate out. I would put it as a consumer discretionary rather than durables. I'll tell you why. Because there's consumer discretionary, which is high-end retail and stuff. That in the festival season, everybody buys a new dress or thing for Diwali. People go and tend to upgrade their brands during this period. So I think the savings there will directly reflect in a good top-line growth in the overall discretionary space. Now coming to the durables part of it, right? Now there are two clear divisions there, right? There's one division which is related to heat and cooling. There's air conditioners, your water coolers, your refrigerators. Obviously, this is not the season for them. So to that extent, the impact of this GST cut and rationalization will probably be felt in the coming summer rather than right now. So what would you, that's why people tend to go and buy a vehicle now to the display. Yes, some like durables like washing machines and dishwashers would see a good pickup at this. So you're going to clearly separate out the kind of distributor, because honestly you don't buy an air conditioner when it's winter is approaching, right? You're not thinking about buying an air conditioner. So that's the thing with the consumer durable space, that is you got to look at it company specific and the type of product specific rather than just overall take it as one consumer durable pack.
Okay. Now that we spoke about a whole host of sectors, Sunil sir, any other sector that you believe that the market is not right now pricing in, but you believe that this is something that could outperform in the upcoming days?
To me, that's industrial capital goods. I was saying industrial capital goods and public sector banks, but the market has picked up on public sector banks already. But industrial capital goods, because see, the one clear thing, like I said, the GST cut is going to lead to a sharp rise in sales across the consumption space. But at what margin cost? Right? Whether those margin sacrifice happens to boost the sales by the banks as well as this. But the clarity is that the top line will grow. I think that much I'm pretty much 90 to 100% confident that a lot of top line growth is going to happen across the consumer space. Now that top line growth's impact, right, will be clearly felt in the capacity utilization in the country. So when the next 6 to 9 months, you will see that the capacity number should already inch up closer to 80%. And that's a trigger point for private capex to kickstart the cycle, because it takes another year and a half to build those new factories or the expansions or whatever, right? So they have to start at some point, and so that in 2 years from now, they're ready for it. So that trigger movement, right, will, I believe that is then give a huge boost to the suppliers of industrial expansion. So for me, in the manufacturing space, the industrial space where they supply the EPC contractors and the people who cater to expansion of these factories, right? That's the key, which is today not yet reflected, because people are still focusing on the consumption and the near-term gains and what's going to happen to banks, what's going to happen to IT. But if you just stretch your outlook to a bit over, let's say, 9 months to a year from now, and then for the next 3 to 5 years, I see that you'll have a very good capex cycle going through. So to me, within the overall infra space is the industrial space, which I feel that the market is yet not caught on to in full speed. And when that revelation comes through, the prices will, order books will shoot up, then the prices will shoot up. So it's a good time to start taking allocations into that. Do it in a staggered manner, because markets aren't going to change overnight, but it's a good time to build a portfolio in that space, I believe.
Okay. All right, just one last question before we let you go, Sunil sir. You did mention that for the FI trigger, that is your US-India trade talks to take place. But for you, what is the next big trigger that the markets have been watching out? Is it the trade talks that is yet to fructify, or do you believe that the result season is something that will help move markets ahead? What are you seeing next?
No, see, for me, it's the trade talks which dominate the thing, because see, the market and the FII growth return to India is critical for the markets to get out of this consolidation mode that it's been. 1 year return on the Nifty is just flat or negative or positive, depending at what time you look at the screen, right? So which means in the last 1 year, the market hasn't gone anywhere from a large cap perspective. And the FI's decision to allocate out of India, started last September, if you remember, has paid off, because India has been one of the most underperforming markets. So they made a very good tactical call and it's worked out. Now, because of that, because the Indian markets haven't corrected too much, right? The valuations still haven't become that reasonable. So purely from a valuation perspective, for them to come, like as there's a crossover quarter, so you might see the longer term oriented FIS coming back based on the earnings guidance as they revise their forecast for the year 2027, FY27. So while that is a gradual process, but as a trigger, I think that it's the basically the Trump tariff trade talks all are in tea, right? So to me, that's the way I say it. The market is paying the price. There's something coined called the TERP. This is the Trump trade tariff. All the T stands for that uncertainty risk premium. So that's the risk premium that India has to pay the price for. And I think once there is clarity there, there'll be a huge boost. So that's the dominating factor. But given the fact that's a yes or a no, it's like either it's going to happen this quarter or not happen. For me, the earnings guidance is the second most important thing, as you asked for. Apart from the tariff related thing, I think is the outlook of the companies for the next year, which is going to fashion the forecasted EPS, consensus EPS growth for the market. And then basis that, India might look a little less unattractive even to an FII. So I think that's the probably what I will look for.
Okay, okay. Earnings guidance, that is what we need to watch out for. But with that, we have to let you go, Sunil sir. But thank you so much for your time and connecting with us.
Thank you.